Hi, welcome to Econ 110, Principles of Macroeconomics, Measuring a Nation's Income. I'm Sue, your instructor. Please use this recording in addition to the textbook and other materials to prepare yourself for class discussion. In this recording, we'll attack Gross Domestic Product, or GDP, the one economic statistic that's thought to be the best single measure of a society's economic well-being. We often consider our own personal economic well-being as starting with our level of income. Our assumptions are that with higher levels of income, we can more easily afford necessities such as food, clothing, and shelter, as well as luxuries. So we say that economically speaking, people with higher incomes enjoy a higher standard of living. We learned earlier that a country's standard of living is tied to productivity. GDP is a standard measurement of productivity used to compare current growth to historical growth and to compare size and growth rate of economies around the world. GDP is defined as the current market value of all final goods and services produced by a nation's economy during a given income period. Market value means price rather than cost. All final goods means all legally sold final production. This also includes rent and other income from housing. All final goods excludes goods we grow or make and use ourselves, like garden vegetables. By the same token, goods sold illegally are not counted as they are not sold in a recognized market. Goods and services include tangible goods like phones and groceries, as well as services such as telephone plans and charges. Produced in an income period means new goods, currently produced, but not antiques, used cars, or used clothing. By a nation's economy means within a country, even if by a foreign worker. Goods produced by American companies in other countries are not included. In a given income period usually means in a given year. Quarterly data is reported but is seasonally adjusted and sometimes expressed as an annual rate. U.S. GDP for 2012 was around $15.7 trillion, roughly a quarter of world GDP. Because this number is quite high, GDP is sometimes quoted on a per person or per capita basis to make it more real. The four components of GDP are consumption, investment, government purchases, and net exports. Now let's look at these four components in more detail. Consumption is spending by households on goods and services except for purchases of new housing. Spending on education is included. Investment is the purchase of goods to be used in the future to produce more goods or services. This spending includes purchases by firms of capital equipment, inventories, and buildings, including household expenditures on newly built homes. This idea of investment is quite different from our typical understanding of personal investment, such as saving or buying stocks, bonds, or mutual funds. Government purchases include spending on goods and services by local, state, and federal governments. This includes salaries as well as purchases such as equipment and supplies. Government spending does not include payments such as Social Security or Medicare. These are called transfer payments because they're not made in exchange for currently produced goods. In other words, they don't reflect current production. Net exports are purchases of domestically produced goods by foreign entities, minus the value of imports. These are netted out in order to more accurately reflect productivity or domestic production. Earlier, we said GDP is used to determine growth within a country or to compare multiple countries. In this chart, you see U.S. GDP for the years 2009 and 2011 in trillions of dollars, along with the percentage of dollars in each of the four categories. Here we can see that consumption is by far the largest category, representing just over 70% of GDP in both years shown. The important underlying assumption here is that for an economy as a whole, income must equal expenditure. We say this because every transaction has two parties, a buyer and a seller. Thus, every dollar of spending by some buyer is a dollar of income by some seller. We saw this in the circular flow diagram, where money continuously flows from households to firms and then back to households. As an example, Karen, as a buyer, pays Doug, who is a seller, $100 to mow her lawn. This transaction contributes equally to the economy's income and to its expenditure and increases GDP by $100, whether we measure GDP by income or expenditure. Remember, the circular flow diagram is a simplified model, but when we add government purchases and investments by households and firms, expenditures do approximately equal income. We can compute GDP either by adding total expenditures by households or by adding total amounts paid by firms to households as income. Because all expenditure in the economy ends up as someone's income, GDP is the same regardless of whether we compute the income or expenditure side. The formula for GDP is this: Y equals C plus I plus G plus NX, or GDP represented by Y equals the sum of the four components. Nominal GDP is the production of goods and services valued at current prices. We said that GDP is one way we measure growth of an economy. In our ice cream example, suppose last year we sold 10 cones at $2 each, and this year we sold 12 cones at $2.50 each. Our nominal GDP would be $20 last year and $30 this year. However, if total spending rises from one year to the next, the cause may be either larger output or higher prices or both. For this reason, economists like to measure GDP in constant dollars. Real GDP is the production of goods and services valued at constant prices or adjusted for inflation-deflation. In other words, we would use prices in the base year to compare quantities in other years. Using the ice cream example, because the price of cones increased, real GDP would be $20 last year and $24 this year. GDP deflator is a measure of the price level calculated as the ratio of nominal GDP to real GDP times 100. In our ice cream example for this year, this would mean nominal GDP of $30 divided by real GDP of $24, which equals 1.25, times 100 equals 125. Last year, the base year, real and nominal GDP were the same, or $20, so the deflator would have been 100. When we talked about trade-offs and opportunity costs, we talked about monetary and non-monetary costs. What does GDP measure? GDP is a monetary measure of productivity, which we relate to standard of living. The question is, does GDP accurately measure the non-monetary costs and benefits of a society? So while GDP is useful to determine growth rates and for comparing productivity around the world, when we talk about standard of living, we must recognize the non-monetary factors as well. Check the text to ensure you understand these important terms and concepts. The learning objectives here will help you prioritize your study. For additional detail, refer to the additional resources in your text.